This is going to be an introduction to how I place trades before earnings and what I look for in the options tables as they pertain to deltas. I'll keep this as simple as possible, and if you have questions for more detailed answers, I will happily provide them in the comments. So I started with a watch list, and the watch list is something that I built on Thinkorswim. I could send you the parameters if you're interested in that, but basically it's looking for upcoming earnings within 10 bars, and it's looking for bullish Ichimoku. So it's going to whittle everything down into these 5 matches. It also looks for implied volatility that is above 50% and a large volume, so the bid-ask spread is pretty tight. So first one is Tyson. These all have upcoming earnings. Now Tyson Foods is trading very, very bullish. So what I'm going to do is sell a put. And the reason I'm going to do that is I am giving somebody the right to dump their shares on me, meaning they will lock in a purchase price. So I'm going to sell the right for them to lock in a price of around between $65 and $68, and that is going to give me several advantages. First, I want to get into the stock. Tyson is just going gangbusters. Look at the bullish Ichimoku that goes back to February, and it's just been on a tear. So the Tenkan, the Span A, it crossed over here and it's been bullish ever since. The Chiku, the 26 period trailing average, has been bullish as well. So I want to own this stock. So what I'm going to do is sell the put, which means I am saying I am willing to buy Tyson Foods off of you for a price of $65. And if Tyson Foods goes below $65, then I will be obligated to buy at that price. So that the reason someone's willing to pay me for that is because there's a risk that Tyson could go below $65 and keep going down. Does that make sense? I'll say it again. There's a risk that if I sell a $65 put, that Tyson could go from where it is now, a closing price of $74 today, all the way down to $65, which would force me to buy Tyson Foods at $65. And the risk is that it will continue to fall below $65. Does that make sense? So let me show you what that looks like on the options table. I wanted you to get an understanding of what that is conceptually before I give you the details. And don't look at anything else on the options table yet, otherwise you're going to get confused. Just look at what I'm pointing to. So we're going to go to the next expiration, and because obviously, today is Friday, April 26th, market's been closed. May 3rd will be the next expiration. And there's a large amount of implied volatility for that one. Not as much as May 10th, but Tyson Foods. And just to double check when earnings is, Earnings Whispers is my favorite site for that. May 6th. So this, Monday of next week. So we need to look out and find an expiration date that is after May 6th, but close to it. So today, again, is Friday, April 26th, and that means earnings for Tyson Foods will be on the Monday after next. So what we need to do is go back to the options table. We want to find an expiration that's after May 6th, because we want the option that we're selling to expire soon after the earnings date. And the reason I like doing this is because the decay after earnings is significant in terms of implied volatility decay. So the decay of the implied volatility, they call it implied volatility crush. Think of implied volatility as a balloon that expands before earnings, expands, and then it usually pops right after earnings are announced, because there's an uncertainty that's associated with implied volatility, because it's an uncertainty as to which way the stock will go after earnings. And right after you get your answer, you know, okay, things are looking good or things are looking bad. That eliminates a large amount of the implied volatility uncertainty. And that's why the premium that people pay for implied volatility before earnings, because there's so much possibility it could go either way, is overcome with the earnings announcement. And that's why you want to buy or sell. I mean, you want to sell your options close to the actual earnings report. So Thinkorswim is being awful, or the trader app, and it's completely lagging here. Let's see if we can get it back up. Okay, there we go. So again, May 6th is when it announces. So we're gonna have to go to the May 10th expiration date, and that will be on a Friday of that week. So May 10th. Now here's where it matters. So let's take this one step at a time. Ignore everything that I'm not showing you. Okay, so this line here, that signifies where the price break is. See how the shading is different too between over here? So right now, Tyson, you see the close price is around $74. So we're gonna sell a put, because remember, we want to say that if Tyson goes below a price of $69 right there, then we will buy your shares at $69. So as long as Tyson stays above $69, then we don't have to do anything. We keep the premium. In other words, we keep the price that we sold that option to. The option will be exercised by the person who purchases the put option. I'm selling the put option. The other side of the transaction is the person who's buying the put option. And I am betting that Tyson does not go below $69. Now over here is the delta, and the delta is important because as you go lower and lower in price, there's a lower and lower probability that Tyson will go that low. So if we go all the way down to the lowest strike available for that week, $60, that has a delta of 0.02, a very, very small probability that Tyson will go down to that. And that's why you would only make about $8 a contract. See the 0.08? So the 0.08 means that's per share. You multiply it by 100 because a call option represents 100 shares. But they, instead of showing it as the full price, they show it per share price. So if I sell one put option for $69, I will take in approximately $68. See, it's 0.68. That's what the mark price is. I mean, I should go to the bid price. That's more accurate. But hey, so the bid price, 55. All right, and I want to go to sell. See, it's $54.35. So that's about how much premium I will take in for selling that put. Now, I like repeating things in, the same message, but different ways, just to make sure you're understanding it from multiple angles. I'm just going to recap here. I am selling somebody the right to buy this protection of a put. A put, for most cases, is protection. And why is that? Because if if I own shares in Tyson and I am nervous that Tyson could go below $69, well then I would want to buy a put, and that provides insurance. Because if Ned, hey, come over. Sorry. So if Tyson goes below $69 and I bought that put, then someone will buy Tyson from me at $69. Inside. Sorry, talking to my dog. So someone will buy the put from me at $69, and then it's off my hands. I don't care that Tyson goes to $60 or $50 or $40. I've already gotten rid of it. I exercised that put option, and the person who sold the put to me was forced to buy the shares at $69 because that was what the agreement was. And now if that person who sold me the put, right, who now owns the shares because I exercised my option, the buyer of the option always has the right to exercise the option. They never have the obligation. But because I bought, I know I'm talking, let's say two different people, all right? Let's make this more understandable by separating it between two different people. So if I sell a put to my brother, and let's say his name is Matt, then Matt has the right, but not the obligation, to exercise the put if Tyson is tanking in value. So, you know, Tyson is trading at $74. I don't think Tyson has a high probability of going down to $69. And the reason I think that is because the Ichimoku is my primary indicator, and that shows bullish sentiment. It's been bullish, and it's showing with the forward-looking Ichimoku with the span A and the span B. It's showing that it should continue to be bullish, notwithstanding, you know, any black swan events that do occasionally happen in the market and will happen. So, you know, notwithstanding food poisoning being discovered by one of Tyson's chickens or something of that out of the ordinary effect, Tyson should not plummet like that. But if it does, and someone gets salmonella poisoning, for example, because of some Tyson chicken, then Tyson would plummet. It would go down to $69. It would shoot past $69 and keep going down. And what would my brother Matt do? Well, as he sees it going down below $69, and he doesn't have to act immediately. That's the beauty of American options. You can look up European options for the difference, but with American options, my brother Matt can let it go even past $69 until the expiration date of that option. So remember, I'm selling the May 10th option. So my brother Matt has until May 10th to decide if he wants to exercise the option and obligate me to buy his shares at whatever price they're trading for, below $69. You know, they could be trading at $30. It could be a disaster. You know, something like that happened to Boeing a couple months ago with the 37 MAX scare. It shot past over, it was trading originally around 420 and it got down below 380 just in a matter of days. So people that purchased puts, the put buyers, right? So my brother Matt purchased puts on Boeing for something like $380. Well, anybody who was selling the puts, they would think there's no way Boeing's going to go down this low. Of course, you know, I'll sell this because only a sucker would buy a put option that is so unlikely to be exercised. And there's a term for that. It's called out of the money. So if Boeing is trading at $420 and you sold a $420 put, well, that would be an at the money put. When it costs the same as when the strike price of the option is the same price as the price of the underlying stock, then it's called at the money. So if you sell, as an option seller, if you sell a put that is far, far below what it's trading for, in other words, for this example, you sell a put in Boeing for $380, then you're selling an out of the money put. You understand? It's out of the money. It's far, far below what it's currently trading at, what Boeing is currently trading at. And therefore, it's very, very unlikely that Boeing would dip down from 420 to 380 and continue to go lower than that. But that's exactly what happened. So that would be kind of one of those individual black swan events, because it's so out of the ordinary, but it's not impossible. So they're cheap protection for people to buy. It costs them just a little bit to lock in that insurance. And the people that had Boeing puts, they certainly wanted to exercise that insurance once Boeing got so low. So the people that bought, the $380 put, that far, far out of the money insurance, thinking just in case I should buy this, and then the second crash happened in Ethiopia, well, even though they bought a put that was so far out of the money, when Boeing went to 380 and when it went to the price of $380 and it went even lower, went down to $350, and their option hadn't expired yet. Let's say they had an option, expiring in June of this year, and in the past few months they've seen Boeing go from over $400 down to $390, $380, $370. They have to decide, all right, well, do I exercise this now that Boeing is under $380, and therefore I give up my shares? The person who sold me the put, who agreed to take on the risk of Boeing plummeting in value, they agreed to take my shares. So do I give them my shares, for the price that they agreed to pay, or do I think that this is just a fluke, and do I want to hold on to my shares thinking that Boeing will recover and go back above $400? And if that's my thinking, then I hold on to my shares, I don't exercise that put option, and I lose the money that I spent to buy that put. So for this case, for Tyson, I'm selling the put, and I'm selling a May 10th put for $69. And what is going to work in my favor, there are two things. One is the Ichimoku is showing that Tyson is very bullish still. It's been bullish, it will be bullish. So that gives me a good probability, and I'm always talking good, meaning better than 50%, never 100%, but somewhere between the two, that because of how Tyson has done in the last quarter, that is evidenced by the chart, it has been strongly bullish. So there's a high probability that Boeing will continue to be bullish. It's also a high probability that the earnings will be positive, considering how Boeing has traded since over the last quarter two. So now I have that in my favor. The second strong point in my favor is that I'm going to pause. So here's the order screen, and what that is showing is that I am going to take in about a $55 profit, including the commission, and I am going to sell this put expiring May 10th. So let me just run through the numbers. 10 May 19, that means May 10th, 2019. It has to be exercised by the close of trading by May 10th, 2019. And if it's not, then I keep all that premium. In other words, I will keep $54.35. That's all I stand to make. And it sounds worthless. It sounds ridiculous, right? Like, why would I only want to make $54.35 when, I could theoretically lose thousands more than that? This is a naked put, right? It's risky, right? But it's not actually that risky. I'll tell you why. Because I want to own Tyson. if I get exercised and I'm forced to buy Tyson at $69, even though Tyson is going lower than that, that's a risk I'm willing to take, because I'm willing to buy Tyson right now at $74. So you combine that. Let's go through and step 1, step 2, step 3 in order of why I think this is going to be a good trade and why I would be happy even this turns out to be a loser. A, I want to own Tyson. I'm willing to own Tyson at $74 because of how bullish it's been and how bullish it is headed, according to the Ichimoku. B, I want to take in a $55 credit. C, I want to own Tyson at $69, which is about $4 to $5 less than it's trading for right now. And in addition, I guess maybe consideration D, is that this has a very low likelihood of being actually exercised. This has a low likelihood of this low delta losing. And another thing is, even if Tyson goes down to $69, it's unlikely this will be exercised, because why would someone want to exercise the option at $69 if that's the price it's trading for on the market? They could go out and buy it or sell it at that price. So those 4 considerations make it very likely that this will be a winning trade, and I'll keep 100% of $55. Now, this is a naked put, meaning it has undefined risk, because if Tyson goes below $69, it could keep going lower than $69, and there's no way to know what my max loss would be. Tyson could theoretically go to $0. That would be my max loss, but of course that's highly unlikely. Companies don't usually go bankrupt from one earning cycle to the next suddenly without especially when they're having a bullish trajectory following a bullish history. So this is why I'm selling what's called a naked put. And you won't be able to do this when you're just starting out, and you wouldn't want to do this when you're just starting out. But naked options, meaning just selling a put or just selling a call without buying a put to cover it, those are considered the most risky, and that's why you can't do it usually in some retirement accounts, and that's why you can't do it without getting tier 3 approval, and you have to start usually at tier 1. Your brokerage won't let you just jump into naked option selling because it is considered risky for that reason. The reason I told you that Tyson could just keep going down past $69. So I don't think that's going to happen, and it's more than just a bet. The statistics say it's highly unlikely, and the critics could say, well, just because it's unlikely doesn't mean it's impossible. And everything in life is a gamble. There's nothing that isn't. So this is not just a gamble, it's a calculation. It's based on probabilities, and everything in life is a gamble. Everything in life is also probabilities too. You have a higher probability of making more money in your adulthood if you go to college. You have a higher probability of going to college if you do well in high school. Everything's probabilities, everything's a gamble. So with this put, I'm selling it. It's going to expire May 10th, and the implied volatility right after the earnings on May 6th will mean that even if Tyson beats earnings, it's going to make me money, and I'll be closer to keeping 100% if it beats earnings. Even if Tyson misses earnings and goes down, I'll still have a higher probability of this option expiring worthless and me keeping the premium, unless it misses earnings by so much that it immediately goes down below $69. But if it just stays the same, let's say earnings are mixed and Tyson barely moves, well then my option will still be more profitable because the implied volatility will have gone down. Remember, the implied volatility is that uncertainty of what is going to happen with earnings. And once the answer has come out and we've heard that the earnings will be positive or negative, once that is no longer vague, but it's actually established, then that implied volatility, that uncertainty has gone away. So the option that I've sold is now worth less. And the reason we want something that we sell to be worth less rather than worth more is that if we ever need to buy it back, we can buy it for cheaper. And that's essentially an arbitrage, and we will keep the difference. So I don't think I need to use an analogy because that might just complicate things, but I'm going to repeat it. If we sell an option, we want it to start losing money. And the reason is that option can still be bought back by us if we want to eliminate the obligation, right? Because if we sold the option, we sold the put before earnings, and after earnings, the put option is still in place. Let's say Tyson is, today it's $74, and then the day after earnings, it's $70. Well, it looks like it's going down, right? It started at 74, now it's at 70, and by May 10th, it could go below $69, meaning we would have to buy Tyson at the $69 strike price that we sold the option for. So if that's the case, then we could eliminate that risk of exercise by buying the put, and that would close it out. And if Tyson has lost value, then the advantage is we can now buy it for cheaper. So what we're going to do is sell this put at 55.55. We'll make it a GTC because it's obviously the market's closed today. If we do day, that means it'll just have to fill on Monday or not at all. Let's do GTC because we still have about a week before earnings. And when we get to the confirmation page, it'll show that's our max profit. Our max loss is $6,845, right? That's about if Tyson goes to zero. Max loss, max risk. I don't have any concern that that's going to happen. So what I'm going to do is send that order, and it will trigger. And now it goes into a working order. So I put it at 0.68, and if Tyson, the value of that put goes up to 0.68, it'll trigger. You don't have to worry about that right now. Just know that I sold a put. I sold someone the right to lock in the floor of their pricing for Tyson. So if Tyson goes below $69, they don't have to worry anymore about it going further down than that. They can exercise the put, and that will force me to buy Tyson for $69 a share, even though Tyson could have gone much lower than that. Does that make sense? That's all.